I've only got 10 minutes and this chat is normally 45 minutes. So I've condensed it down and it'll be very quick, but I'm more than happy to expand on it on a one-on-one basis after the talk. So firstly, I'm Paul Mahoney. I'm the founder and managing director at Nova Financial. We're an independent, privately owned property and finance advisory company. We're essentially financial advisors who specialise in property as we view it as the best asset class for creating and storing wealth for the broadest range of people. Firstly, we're a regulated company, so it's important for me to say that anything that I do say today is very general in nature. It's not personal to you, so you shouldn't make changes based upon it. You should seek personal advice, which we can help you with on a one-to-one basis, and we'd be more than happy to. Right, so some of the things I'll go through. I'll introduce us in a little bit more detail, just so that you know what direction I'm approaching this from. I'll talk about some historical returns, so property versus other asset classes, and I suppose that's part of the reason why we prefer property. The ability for leverage with property, which in my opinion is the major benefit that property offers over other types of investments. Reinvesting in liquidity, diversification, and some questions at the end. So firstly us. So my background is financial planning. I used to run a publicly listed company called Spring Financial Group in Australia. We were a full-service financial planning and advisory company. And we spotted a massive gap in the market between estate agents and financial advisors. Estate agents are just trying to sell you something, and it's very difficult to rely upon their advice. Financial advisors, who in the right circumstances are quite good at advising clients toward their goals, but mainly focus just on equities and pensions. So there was no real independent advice or support network for people who preferred property, and we preferred property when we compared it to other options. And that's the gap that we aim to fill. So that's essentially our services. We advise on all aspects of property investment as a vehicle for wealth. So helping you understand your goals, putting in place a strategy, sourcing the most suitable assets to fit that strategy, specifically property, financing them, managing them, reinvesting and working toward your end goals over the mid to long term. I'm a qualified financial advisor, mortgage advisor. I'm a property investor myself. We've helped thousands of people invest in property quite successfully. I've been in the industry for just over 10 years, but I'm supported by what we call our advisory panel, which is our management team, and we have well over 100 years of experience between us, and very strong relationships and strong networks throughout the UK property market, which opens a lot of doors for us, enables us to get access to the better opportunities and then pass it on to our clients. But our big point of difference is the fact that we're independent. We don't have anything to sell. And to my knowledge, there's very, very few companies in the UK like that when it comes to property. So that's what we can assist with, and we do so on a daily basis, and that's our big point of difference. Property versus shares. So age-old question, not a very simple answer, but as I say, if we thought shares were better for most people, and when I say most people, I'm talking about mum and dad investors, your average investor that's looking to be quite passive, we'd advise on shares, but we just prefer property. And I'll tell you some of the reasons why. Firstly, historical returns. So this graph here, it's from a report called Buy to Let Comes of Age. It was done in 2013 by a research house called Wrigglesworth, and it was commissioned by Paragon Mortgages. It looked at what £1,000 would have done over the 18 years to 2013, so far as investments go. The first bar here is a 75% leverage buy-to-let property, so the average across the UK. And the average return was 16.3% per annum on that cash. Cash purchased buy-to-let was 9.7, commercial property 7.9, FTSE All Share Index 6.8, gilts cash. So, I certainly know where I'd like to have my money, and that's the average. Most of our clients are achieving gross yields of around 7 or 8%, which on current interest rates will give you an ROI, so cash on cash return on your money you've invested of 10% plus. That's cash in your pocket every year. Add to that 5% capital growth, which is the UK average for the past 20 years, and you're at over 30% return on the cash you've invested per annum. And some people would say to me, well, 30% return isn't sustainable. But actually, it very much is. because it's driven by a 5% capital growth on the total asset value. Remembering you've only put in a 25% deposit, so 5% on the total asset value is 20% on your cash, plus the 10% ROI. So you're achieving relatively average returns on the asset, but 30% plus returns on your cash. There's no other asset in the world that will generate those sorts of returns with that sort of risk profile. That's why we prefer property as an asset class in compared to other types of investments. Which is right for you, it very much depends, but some of the sort of characteristics of property versus shares. Obviously, higher yields. As I say, most of our clients at the moment, if we're looking at the UK, are investing in the northwest, so predominantly Manchester, Liverpool, fairly substantial cities with depth. They're actually growing at a really strong rate at the moment, regardless of a lot of the changes that have happened in the market recently around buy-to-let property. And in fact, in spite of it, it's actually causing quite a strong trend toward lower value, higher yielding properties, away from higher value, lower yielding properties, which is predominantly London and the southeast. So there's a big shift happening in the market at the moment. And of course, as we all know, it's important to invest with those trends and take advantage of them. Obviously, another benefit of property is the stability. If we look at the last financial crisis, although some people would say that property caused the last financial crisis, that's not true. It was caused by silly lending. If you look at how it impacted the market, the FTSE All-Share Index fell by 32% in 2008. Property fell by 8%. Look at the following year, property fell by a further 8%. So 16% was the total downturn in the UK property market. Then the market turned. And if you look at London, for example, we're now 75% beyond the 2007 peak property prices. So far as stability goes, and I suppose the ability to protect yourself from yourself, in that nobody sells property when they see on the news of the morning that China's having economic issues. People do that with shares. So you kind of, if you're worried about not having the stomach for risk, property is definitely the better option because you don't have a ticker on your letterbox. Shares obviously offer more ability for diversification and liquidity, but as I've just mentioned, the liquidity side isn't necessarily a good thing. When you're looking for mid to long-term wealth creation, having an asset that is more difficult to dispose of, more difficult to quickly dispose of based upon a whim is sometimes a positive. Getting advice here is absolutely important though. Determining what investments are right for you based upon your stage of life, what you're trying to achieve, all those sorts of things, your risk profile. Again, that's where we fit in so far as being able to do so. I'll go through this very quickly. This is 1985, they did a study on Harvard MBA students, or a survey, sorry. They asked them, have you set clear written down goals for your future and made plans to accomplish them? 3% had clear written down goals, 13% had goals but they weren't written down, 84% had no goals at all. 10 years later, the 3% were earning 10 times as much as the other 97% combined. The point there is have a strategy, write it down. It can change every day. It doesn't need to be set in stone, but at least by having one, you have some direction. Again, something we can help with. We're offering a promotion for the show. So we have offices in London, Manchester and Birmingham, head offices in central London, and we offer a complimentary meeting there to determine if there's a fit and if we can be of assistance to you. That meeting is that initial introduction. After that point, we usually charge a fee, which ranges between £500 and £2,500, and the promotion we're running for the show is we're offering to waive that. So our initial advice to you would be completely free of charge. So no obligation, not much to lose, but potentially a lot to gain. Each of you should have a feedback form. If you don't, please raise your hand and my colleagues will give you one. On that form, you can apply for this promotion, or we're on stand 36, so you can come over and see us just at the top of the stairs there, and we're more than happy to have a chat with you in a bit more detail to see whether we might be able to help. Oh, God, take a breath. This is our advisory panel. This is where that advice comes from. I've spoken about myself a little bit, but there's lots and lots of experience here. So far as So the way our business works, we have our front office team, the back office team, or what we call our advisory panel actually generates that advice. And this is that level of expertise that we have. It's all on our website. Okay, great. Feedback and questions might have to happen afterwards. I'm being kicked off already, but I'll be out the front to have a chat with anyone or come and see us on our stand. Thanks very much.